Good afternoon. We're going to do an update of a video I did on 2/27 regarding a crash-proof two-stock portfolio. This type of investing is extremely simple. It's very safe, and it really works well in a market like we have now. Now I'll show you what the original premise was. This is what I used on February 27th. This is how to invest $1,000 in the market with a two-stock active portfolio. So what you do on the long side, if you have $1,000, you take 85% of that, which would be $150. And at the time of this video, the VTI was trading at $172. So once you buy it, you put in a trailing stop, which is a type of sale. You can see it when you hit the sell button. It's a conditional sale. But anyway, you put a 5% trailing stop. That means it can go up as much as it wants, but it'll only come down 5%, and then it'll sell you out. So the reason I picked 5% is with the VTI, if it goes down 5%, something sinister is happening to the market, and you probably don't want to be in anyway, which was definitely the case this time. So what has happened so far? It declined the 5%, and it was sold out of the market. I was sold out of the market. I was down like $34. It was actually, I had a bigger portfolio, but the percentages are the same. I was down 5% on the position. And then on the other side, I purchased the VXX. And with the other 15%, which would have been $150, which was 12 shares at about, I think it was around 13 and change. Now, the idea was when the market tanks 5%, the VIX is up 10%, which was not the case. It was up considerably more than that. So your net loss, but we'll go with the 10%. Your net loss was $19, and then if the market continues to tank down 20%, which it's done way more than that, the VXS goes to 34.50, which it's twice that right at the moment. But 34.50 was the 52-week high. And then, you theoretically make $414. It'd be just about twice that. And then you're actually on the plus side. And then you put a trailing stop. I had 200 shares of VIX, and I used a different type of strategy. It was one I used in 2008, and it worked well then, but it did not work at all this time. It would throw out a 10% yield, and I would hedge it with VIX. And with these 1,000-point up days and 2,000-point down days, it was like the VIX did not stabilize the portfolio. So I put $5 or 5% stops, and I was stopped out of the entire portfolio. I retained 200 shares of VXX, and then I put a 15% trailing stop and on all 200 shares, and with the volatility in the market with 1,000-point up days, and I was stopped out of the VIX. So VXX. So what I did is I rebought the 200 shares and only put a 15% trailing stop on 100 shares. And lo and behold, I was stopped out of that due to the market volatility. And as of right now, I have 100 shares of VIX, and I'm flat. I don't have any equity exposure. So even if you were stopped out of the VIX, you would be flat. You would not be in this market. Your risk would be zero, and this market is absolutely deadly. So it is risk managed, and it does do better in a down market. But even if it was an up market, what you would do is you'd get out of the VIX, and then you'd put it in the VTI, and you think, well, that's only one position, but the VTI is the U.S. stock market. So it would be the most diverse portfolio or one up that you could possibly get. So let's see what's going on today. day. Okay, now like I said, here's the VIX, and it is up 28%. You see, it's considerably more than the 10%. So the more crazy the market gets, the more volatile this becomes. So in theory, not in theory, at this moment, I am up $1,600 on 100 shares of VXX. And I have zero equity exposure. So to me, it's very safe because it takes you out when it's bad and the market gets bad, and then you actually have some upside when the market tanks. So let's say, okay, you think, wow, this is up, it's the 52-week high. It's too late for this. Well, let's take a look. Here is a chart going back 5 years. And right now it's at the $78. But if you go back here, this December 1st, 16, it was 102. If you go back May 16, it was 217. And if you go back February 16, it was, let's see, 385. So is it done? I mean, how crazy is this market going to get? But I don't really care because I'm in the VIX or VXX, and if the market goes down, I'll make money, and if it turns, I will cash out and put a trailing stop. But as it is now, it doesn't look like it's going to get better. This is going to be the most crazy market in, I think, a generation. So be careful. If you are in stocks, I would go to cash or bonds. Even bonds are getting hit. But do not be in this market. If you have a bunch of 401ks scattered all over the place from previous jobs, roll them into an IRA and do something like this strategy. And if you have a 401k active with a company, definitely go to bonds, go conservative. If they have a money market, go to that, because I don't think we're anywhere near done, and this could get worse. But if you're not in the market, I mean, you sit back and watch, or you do what I'm doing is sit back and make a little money. So this is what you do. This portfolio is extremely simple, and it basically can take the market concern out, because you've defined your risk. You defined, okay, I'm going to take my marbles and get out of this sandbox at this point. So it's worked. It's makes sense, and it's simple. So I hope you would all consider this going forward. It's definitely a viable strategy, and I hope you've learned something. And if you do like it, hit subscribe. I've got other ideas in this crazy market. I'm a retired financial advisor, and I retired in January, thank heavens, because God, I would hate to have clients in this market. I mean, they'd all be in cash. It would be no question. But anyway, have a good day, and thank you for watching, and I hope it gets better soon.